Great. Well, thank you very much for being with me today here. When David invited me to make this presentation on the Elliott Wave Principle, I figured there were going to be many other presenters showing you the basics of Elliott patterns, rules, and guidelines. So I started wondering, what was the one thing about the Elliott Wave Principle that I could teach you in 1 hour and that you would be able to put to profitable use in 1 day? And the result of that thought process is what I'm going to share with you here today. So here's my big promise to you. I'll do my absolute best to give you real, applicable knowledge that you can use in your trading right away. And by the end of the training, you'll have the necessary tools to improve your trading immediately using the wisdom of the Elliott Wave Principle. When we start trading, it is hard to believe that trading methodology, although a key element in order to earn money consistently in the market, is really the least important aspect of the trading success equation. We could arbitrarily give it a 10% of importance and divide the other 90% equally between behavioral finance and money management because they are truly interrelated. A robust trading methodology also involves 3 aspects: a defined approach for entering trading positions, a defined approach for exiting trading positions, and of course, trade management. Trade management is a disciplined way to manage open positions using trade targets, protective stops, trailing stops, etc. Without one of these elements, you simply don't have a reliable system to participate in the markets. And in today's training, I will provide you with a proven methodology using the Elliott Wave Principle. And no matter if you are a scalper or a swing trader, the very first step before we take a trade is to know the trend. Hence, the best thing we can do is to uncover the mysteries of the trend so you can easily identify it without years of study, without years of experience, and I would say without major losses and frustration. Once you understand how easy it can be to identify the trend and how to differentiate it from counter trend moves or corrections, you'll be able to avoid sideways markets and, of course, unnecessary losses. And most importantly, you'll be able to decide in what direction to trade. At the end of the training, we'll have a section with questions and answers. I suggest you write your questions as we go along, but I'll be answering them at the end of the training. Otherwise, I'll lose focus and then we won't have time to cover everything that we have planned to cover for you today. Now, let me take a minute to tell you a little bit about me. I have been a diplomat, a concert artist, a success coach, a professor in several universities and conservatories around the world. But let's be honest, all of that is completely irrelevant to today's training, which is about trading. So the most significant piece of information I can give you about me in regard to trading is that I'm an awarded certified financial technician from the International Federation of Technical Analysts. I hold several financial market designations, among which I'm proud to include the CIVA, that is a Certified Elliott Wave Analyst. And I'm also a member of the Society of Technical Analysts in London and Switzerland. Up until last year, I worked as a COO of Stanton Analytics, which is a company that for the past 26 years served 8 of the 10 major oil corporations in the world. Our last list of clients includes Shell, Chevron, BP, Conoco, PetroChina, Bank of America, JP Morgan, and many others. But obviously, I was not always a successful trader. As I started trading, I too had great hopes of being able to generate money fast and easy, and sadly that didn't happen as I expected. I had lots of losses and saw my savings going away fast. I tried many things, but nothing appeared to work. And it was very frustrating because I was used to being successful in everything else I did, and trading was not one of them. So I had to take a decision. Either I went all in and become a real trader, or I had to give up before all our savings were gone. I was fortunate enough to associate with serious trading professionals who showed me that the true path to success in trading was a solid foundation in technical analysis. And it was then that I decided to devote myself to the study of technical analysis and the Elliott Wave Principle full-time. Once I understood what I had to do, I followed the path with religious discipline. I devoted years to studying everything on technical analysis, and as a result, well, my life changed. I must admit, however, that as it happens in almost everything in life, the Pareto Principle, or the 80-20 rule, applied to my studies and efforts. For those of you who are not familiar with the Pareto Principle, it basically states that 80% of the effects come from roughly 20% of the causes. In retrospect, I realized that only 20% of everything I studied was useful to me to produce real results. If I only had had someone who would have told me what that 20% was, I could have saved years, energy, money, and lots of frustration. And with that in mind, I'll share with you today a strategy so you can get the shortcut, so to speak, on what works and what doesn't, without spending years studying technical analysis and losing money trying to trade in the meantime. You can now learn only the good stuff, that 20% of the knowledge that actually works, without the years, the expenses, the frustrations that I had to endure to learn this discipline the hard and honestly, in many ways, the very embarrassing way. So let's get started by uncovering the mysteries of the trend. Everything I'm going to teach you today is extremely simple and almost obvious. But don't let its simplicity deceive you into believing it is not effective. The reason why it looks so simple is because it is part of that 20% I was talking about. So we could say that from the technical analysis studies that I did, the Elliott Wave Principle is part of that 20% that produce real results. And out of the Elliott Wave Principle, I am extracting another 20% to share with you today in what I would call a very good trading methodology. It will take me only a few minutes to describe it to you. But first, let's understand the basis of it all. And the basis of it all is the trend. If you have already traded for some time, you know for a fact that while it is possible to make money trading by going against the trend, the fact remains that trading with the trend is actually the easiest and most convenient way to participate in the market. The reason is simple. A trend is a period in which price moves persistently in one direction. That's the key word, persistently. So it stands to reason that if we want to make money swing trading or even scalping, we should try to trade in the direction that price is moving persistently and not in the opposite direction. In fact, I have already mentioned the importance of technical analysis in my life, but I have not defined for you what technical analysis is. Technical analysis is a method of forecasting the direction of financial market prices through the evaluation of historic price and, where available, volume data. The whole purpose of technical analysis is simply to spot trends at the earliest stages possible and then joining it, trying to trade on the right side of the trend, buying things that are going up in price and selling things that are going down in price. That's simple. And to attempt otherwise is extremely dangerous for obvious reason. The question is there an easy way to spot trends that is really reliable and doesn't require years of study? And I'm happy to say, absolutely there is. And the Elliott Wave Principle provides us with it. So let's explore it now. Everybody knows the definition of a trend according to Dow. An uptrend is a series of higher highs and higher lows, and a downtrend is a series of lower highs and lower lows. Well, okay, that's easy. But why is it that so many people lose so much money trading and so often if they know so well what the trend is? And the answer is simply, they go against the prevalent direction of the market. In other words, they don't trade with the trend. And you may ask, but why? If it is so simple to know what a trend is according to the traditional definition. To observe a series of higher highs and higher lows, or a series of lower highs and lower lows, should be easy, right? Well, remember how I told you that only 20% of what I learned in technical analysis was really useful? Here is a perfect example of that. The traditional definition of trend, according to Dow, is utterly useless. It has been failing traders for years. It has been failing you ever since you learned it and tried to apply it. And there is no reason why it will not continue failing you. If you're trying to spot the trends by following that definition, you will be in serious trouble. And I'll show you why in a second. But let me be clear with something. The definition is absolutely correct in a theoretical way, but it doesn't help us on a practical level. And you know what? Your trading account knows that. Look at this chart. It clearly spots a series of higher highs and higher lows. So this is by definition an uptrend. You may notice that every pullback went down between 50 to 61% of the previous swing up. And at this point, it has once again retraced about the same distance. So what should we expect that this market would do next? Go up or down? Please tell me in the chat. It's an uptrend. It's retracing 50 to 60%. And of course, it's producing higher highs and higher lows. And you are correct. Up, up. Exactly. Several ups there. Sure. Based on the definition of an uptrend, we should assume this market is indeed in an uptrend. So with that conclusion in mind, should we buy or sell it? Tell me in the chat, please. Exactly. Several buys. Thank you very much. Okay, indeed, it makes sense to buy right there. According to the traditional definition that we learn everywhere about trends, this is an uptrend. And in an uptrend, we want to buy every pullback, particularly if it reaches 50 to 62%. Why? Well, because one of the things we know about trend, and by the way, that's a very useful thing to remember, is that trends tend to persist. Remember that word. So once they are established, it is logical to buy every single pullback. In this particular case, not only we have the higher highs and higher lows defining the trend as up, but we also have a pattern of prices retracing about 50 to 62% of the previous swing. Prices are now doing the exact same thing. They went up, making another high, and retraced 50 to 60% of the previous swing. That means that your answer, for those of you who answered buy, was 100% correct. Congratulations. But of course, 100% correct based on the traditional definition of an uptrend being a series of higher highs and higher lows. And even if you use a trend line connecting the lows, you will have a valid trend line with several points of confirmation. And the typical setup would be precisely to buy against the trend line, which is pretty much where prices are on this chart on the right side. Now, let me show you what happened. Here is a problem with being correct according to the traditional definition. This chart is the same chart showing you what happened afterwards. A huge sell-off. That's how that definition, which is absolutely universal and is taught in all and every trading school in the world, fails on daily basis. Now you may wonder, well, but was there any way to realize that the trend was not up? And I know that the answer will surprise you. Indeed, there was a way to know that the correct action in this case was to sell. And not only that, but you'll be surprised on how easy it was to spot the sell. You realize how you didn't need to become a financial technician in order to recognize this pattern. Only you needed the basics of Elliott Wave. And by the end of this class, you'll be able to see too. You'll be surprised how your answers in a case like this will be completely different. Let me show you now my simplified approach. First, I'm going to show you how to identify the trend with two simple Elliott Wave patterns. And the fact that what I'm showing you is a lot simpler implies that applying what you're learning today has the power to transform your trading big time, even if you have a lot of experience as a trader. And even if that experience has been a bad one so far. This way of identifying the trend with the two simple patterns I want you to learn, I admit, is an oversimplification of the wave principle that states that when prices move in the direction of the trend, they form waves that are called motifs. And those waves that are formed when prices move against the trend are called corrections. And those two patterns alone can help us identify the right direction to trade with. That is all you need to remember about the wave principle. To start using it profitably, I mean, two wave modalities, motive waves and corrective waves. Motive waves move in the direction of the trend and corrective waves move in the opposite direction. As you will see in just a moment, the pattern I showed you in the first chart was indeed a correction. So with this simple knowledge, we could have identified as moving opposite to the main trend. But if you want to identify motive waves and corrective waves, it is very important that you learn to identify the characteristics of motive waves and the characteristics of corrections. That way, you will define the trend not by seeing higher highs and higher lows, but by defining if a wave is motive or if it is corrective. And the way to do this is extremely easy. According to the wave principle, motive waves are the ones that go in the direction of the main trend, and they always develop in 5 waves. They are labeled with number 1 through 5. But that is not the most important thing about motive waves, because it is rare when you can find a clean 5-wave textbook chart like this one on the monthly yen. You can easily see the 5 waves decline in the numbers within circles. Each one of those waves is supposed to also subdivide into 5. And if you look carefully, there are also clear 5 waves that I wrote inside parentheses for wave 5 circle, which is the most obvious. For wave 5 circle, I mean from wave 4 circle to wave 5 circle, you can see 5 clear subdivisions. And that is really all cool, all interesting, but it is not the most transformative thing for you right now, because you're probably not going to be counting waves at this point. For that, you need a lot more training. And I promise to give you something practical that you can immediately use. So let's do something easier to identify motive waves that doesn't involve counting. Is it possible? Of course it is. While it may take years to master the wave principle, there is a simple way to identify motive waves that you can learn right now. And I'll demonstrate how it works with real examples in real public trades I have announced using this simple approach. The most important thing you have to learn and memorize about motive waves is that they are slim, elegant, fast, without overlapping action between the swings, like this one. This chart shows you a motive wave going up. Notice that there is no overlapping action between the swings. This is the same chart, but I marked the different swings for you to show you more clearly how there is no overlapping action between the swings. And even the small swings within the larger swings show no overlap between them whatsoever. So it is easy for us to conclude that this wave was a motive wave because it was fast, thin, elegant, without overlaps. While in this particular case, it is easy to spot those 5 waves that we spoke about. Counting was not necessary for us to notice that, well, it was fast, it was thin, it was elegant, and it didn't have any overlaps. Corrective waves are precisely the opposite. They move against the trend. They take time because they are struggling against the main force that is pushing prices in the direction of the main trend. So they cannot manage to develop into 5. That means that they typically end after 3 swings that are typically labeled as A, B, and C. I've marked in a square where the clear corrective structures are on this chart. You'll notice that they could not develop into 5. They are not elegant at all. They are kind of fat, let's say. They are kind of sideways. And in this case, they just went down, up, and down, which I label as ABC for you so you could see them more clearly. And then after the C, well, the trend continues. The most important thing for you to remember is that corrective waves are slow. Look how many bars there are inside these 2 squares, and the prices stayed pretty much at the same level. For example, look at the at the big bar on the left of the square in the middle. It's a clear example of fast versus slow. In only 1 bar, the market accomplished so much gains, and it took about 35 plus bars to come down the same distance. That's what I mean by slow. And there is a lot of overlapping action within correctives. They go nowhere. They tend to be fully retraced. And so when you get involved with the market during corrective periods, you likely lose money. Let me show you an example so you see clearly what I mean by overlap between swings. On this chart, you can see how all the swings up and down are all overlapping. As soon as there is some gains, prices come back down and overlap the previous swing high. That shows how easily it can be to identify the trend. Motive waves versus corrective waves. Fast moves versus slow moves. Elegant waves versus fast and overlapping ones. So let's get to the most important technique that you can apply in your next trading session based on what you just learned here now. For this technique, we're going to take the help of one of the simplest tools in the whole universe of technical analysis, and that is trend lines. Look at the move down from the top. It came down fast, slim, without any overlap between the small swings. Actually, it was so thin that it was virtually a single swing down. If you put a clock, it's almost 6 o'clock. Actually, that move was followed by slow, choppy, sloppy, overlapping move up. Notice how many bars it took this market to regain just a small percentage of the losses. So what should we conclude for this market? Is it in an uptrend or is it in a downtrend? Please let me know in the chat what you are thinking. Downtrend, downtrend, downtrend. Very good. That's really, 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 really good. Many down. So you concluded correctly that it is in a downtrend because the wave coming down is motive and it was followed by a correction. Why do we know it is a correction? Well, because it is slow, it is sloppy, it is choppy, and it overlaps all the swings. So what should we do? Buy or sell? Please tell me in the chat. Exactly, sell. And you are correct, guys. Very, very good. This is what happened afterwards. Amazing, isn't it? And you know what the most amazing thing is? The move up made higher highs and higher lows. Yet, you were all able to recognize it as a correction that is necessarily going against the trend. So it was very easy to conclude the trend was down and we should sell. But there is something even more amazing. And you're going to be surprised when you hear it. This is the exact same chart that I showed you earlier when you all agreed to buy. So, in a matter of speaking, I tricked you. But that's how this simple strategy is. When market produce a motive wave, a very elegant, fast, thin wave that is followed by a choppy, sloppy, slow, overlapping move, you know that the trend will continue in the direction of the motive wave. If the motive wave was down and the correction was up, the next meaningful move will be expected to come down. And if the motive wave was up and it is followed by a corrected, choppy, sloppy, slow, overlapping move to the downside, you know that odds are that the market will continue higher. Why? Because the trend is in the direction of the motive waves. And what do we know about trends that is really useful? Remember that? Trends tend to persist. So now you know exactly in what direction of the market to get involved. But remember how we said that a good strategy needs a clear point of entry? So let's discuss where you should enter using this strategy. Let's use the same chart we used before. The only difference is that we will add a trend line. In fact, this type of strategy is ideal for the use of a trend channel. So let's use two trend lines instead. We will simply connect the first low with the second meaningful low, and then we will trace a parallel line that includes the first high, and that's it. The entry will be once that prices break the lower boundary of the channel. But in the meantime, look at what happens. The channel served as perfect resistance for the next attempt to go higher. And the break of the lower boundary of the channel gave the signal to enter the trade using the top as stop. So let's summarize this simple approach. Look for moves that are fast, slim, elegant, without overlapping action within its swings. Then wait for a move in the opposite direction that is slow, choppy, sloppy, and has several overlaps. This will define the trend for you. If the fast and not overlapping move goes up and it is followed by a choppy, sloppy move with several overlaps, that try to go down, then the trend is up and you should buy. If the elegant move is down and it is followed by slow, choppy and overlapping waves that are trying to move up, the trend is down and you should sell. If the move in the opposite direction is not slow, choppy, sloppy and overlapping, then stay on the side. Use a trend line or a trend channel to enter the market in the direction of the fast move. And that's it. Simple as a ring. Now, I know many of you may be thinking that's too easy. It cannot work and be that easy. So I want to show you the anatomy of a trade following this process so you will understand the thought process and level of confidence that this approach can give you. But before I do that, let me answer a couple of questions that people always ask me when I expound this strategy. Question 1. Why use a channel instead of a simple trend line? Well, a trend channel serves two purposes. One, it'll help you identify the potential termination point of the correction. And this is very important. And two, it will give us the confirmation that the correction is over when the channel is broken in the same direction as the trend. And question number 2, why not sell at the top of the channel? And that is a great question, and it helps me explain to you something extra for the technique. This example shows you how the upper boundary of the channel offered perfect resistance. So we will expect prices to drop from there. But the confirmation that the correction is indeed in place only comes with the violation of the lower boundary of the channel. Before prices break the lower boundary of the channel, in this example, all we had was a hypothesis of what prices were going to do. Violation of the lower boundary is indeed a confirmation of our hypothesis. And we don't have to place a trade solely on hypothesis, a belief or a feeling. That type of trade creates serious psychological issues like insecurity, fear, doubts, etc. But if you are an aggressive trader, you can use the hypothesis to enter, but that would depend on your personality, of course, and you need some other confirmations. Once you see the market found resistance on that upper boundary of the channel, you can use an oscillator to take the sell signal. Any oscillator would do. Depending upon your preference or the particular market, you could use percentage R, stochastic, it doesn't really matter. Any oscillator will do. Let's look at the same chart with stochastic so you can see the perfect entry at the top. I placed a vertical line to show you exactly where the indicator gave the sell signal as it penetrated the 80 reference line from above. That signal would have allowed us to basically sell the top and even add to our position with the break of the channel. This technique is indeed a jewel, extremely useful when we're looking for tops or bottoms in corrections. In corrections, because first, remember, we have to identify the trend. So we cannot use this technique for taking the tops or bottoms of motive waves. Okay, so this is extremely useful when we're looking for tops or bottoms in corrections. And this by itself, seriously, can become the before and after experience in your career. Now, I want to show you the anatomy of a trade using this exact approach for a trade I posted in Facebook. I'll take you step by step so you understand what I was thinking at the moment what my rationale was, and even what my stage of mind was as I announced the trade. I got in and, well, has to experience its ups and downs, right? So you can see in my chart that despite the fact that in the past week the market has been sporting higher highs and higher lows, the larger trend is actually down. I took a screenshot of this, and so it doesn't seem clear, so I'm reading it for you. Prices are going up currently, but with that thought that the trend is actually down, we should be looking for opportunities to the downside as long as prices don't exceed the blue rectangle in my chart. Notice that I'm here selling when the market is going up. Yeah, so we are being contrarians here. The potential target for a short opportunity here is below 147.15. Remember, if prices travel above the blue rectangle, it would imply that a new uptrend is in progress. Hence, the risk for short positions should not exceed 150.80. Basically, you can see here, well, I'm walking my walk. I'm teaching you stuff that I use every day in my trading. In fact, we can almost say that in that post, it is a summary of everything I've shown you today. Now, I want to show you what happened the next day. The text says, price reached my proposed selling area, ideally from current levels or not much above it, prices should start turning down. If so, I expect the move down towards 149 to be rapid and somehow aggressive based on the pattern. Notice that I'm now mentioning 149. Why am I expecting that to be the area of resistance, that rectangle? Well, first of all, because that's where the upper trend line of the channel is. And one thing to keep in mind is that when you have a trend channel like this and prices penetrate that trend line, you may not have a correction. So that's a wonderful reason why to use a trend channel instead of a trend line. So, and basically, why am I selling in that area without prices breaking the lower boundary of the channel, as I am telling you to do? Well, because my oscillator, which is not showing there, coincided with the selling area. And that's the reason why I went for it. Now, let's see what happens after that. I wrote, it is very satisfying when our calculations and forecasts work in our favor. Such is the case with this pair. Market hit our targeted selling area and fell 100 pips really fast as predicted by the ending diagonal pattern and reached our first target at 149. A break of the lower boundary of the corrective channel and the 149 area is still needed to confirm our long-term forecast. But as for now, there are no indications that the decline has ended. While the ideal target is still below 147, I've taken some profits and lowered my stop to break even. That way, this trade will be a winner no matter what happens now. Isn't it cool that such a simple strategy to identify the trend can allow us to gain 100 points so quickly, so easily? And that's kind of enough for a nice trade, right? But remember, our target was below 147.15. So in my mind, prices still had lower to go. Therefore, I lowered my stop to break even, keeping a portion of my position still in the trade. By the way, notice that I'm still waiting for the confirmation of the lower trend line of the channel, as I taught you today, to be broken. So if that is to happen, I still have another entry opportunity, right? The next day, prices went back up. And here's what I wrote. Yesterday, I said that a break of the lower boundary of the channel was still needed to confirm our long-term forecast for this trade and market. Price came all the way down to that trend line and it didn't penetrate it. Instead, it bounced from it. Today, we are at the exact same situation. The lower boundary of the channel needs to be penetrated to confirm the long-term trade and forecast. However, we are now able to lower our stop further to above the high of the day at 149.75. If the 149.75 area is eclipsed, that would mean that the blue rectangle resistance area will be tested again or even penetrated. Therefore, in the interest of preserving profits and a good trade management, it will be better to secure more profits right now by lowering our stop to below break even. If on the other hand, the trend line is penetrated, we can expect prices to come below 147, and in the next few days or weeks, if that's the case, the stop at 149.75 would still be appropriate. Good luck in your trade and trade management. You can see here that despite the fact that the market was going against my direction, I still had a level of confidence high, enough as to lower my stop. The trade was already a winner for my first half. The second half was already below break even. So I was in pretty good shape right there. And all I had to do that was the information that you learned here today. The next day, we saw the break we needed or we wanted. At that point, I said, quick pound yen update. After I posted my update this morning, pound yen fell another 140 pips and reached our first target. Long-term analysis still calls for lower prices, but since our entry, the market has fallen 340 pips. So it stands to reason to secure more profits via exiting a portion of the trade, trailing the stop, or a combination of both. Happy trade. Now, 300 pips is a lot of money. And just to make the story short, the market fell another 200 pips right after that, before I made a video indicating that it was time to exit the position with over 500 pips of profit. That happened at the low, and all I did was to use a thin, elegant wave followed by a correction. The idea to show you this trade, it's not to brag about my abilities as an analyst or as a trader, but to show you that the stuff that you have learned here today, in as simple as it seems, can be a life changer. And it is not the stuff that you would use to trade 10 or 15 ticks or pips. This is a strategy that allows for hundreds of pips or ticks of profits. That means thousands of dollars, and you can start applying it immediately. Here I will show you another post with my forecast for crude. On this post, not only I predicted a new high, but I actually I mapped out the potential path for prices based on the pattern at hand. And my drawing is the blue line you see on your screens. I know you may be thinking it is coincidence, but let me read for you what I wrote on my post instead of reading the whole thing. I will just read the relevant paragraph. I have drawn the expected path that prices should take on my chart. Support should be found at 70.30. However, prices could still come below the pivot low at 70.26 and find support at 69.80 without invalidating the pattern. And next day, it was, this is what I posted. I wrote, the path I suggested yesterday for prices to take proved to be almost the exact one. And to make the story short again, this is what happened 2 days later. I wrote, once again, CL followed our expected path, reaching the proposed target. This is not magic, guys. This is simply following the patterns that we learned from the Elliott Wave Principle. More recent forecasts are on our private Facebook group, but I chose these examples because they were taken publicly using the strategy I just shared with you. Now, you can see how prices came down from the top in a very thin, rapid and elegant way without overlaps on this chart. In this particular case, I even labeled the 5 waves down for you because, well, they were textbook. You know, you can see I labeled them in parentheses. You can see 1, 2, 3, 4, and 5 very, very clearly. And that beautiful decline was followed by a move that, despite gaining 78% back of the losses from the decline, it did so in a very overlapping manner. Plus, look at how many bars it took this move to be able to gain back only 78%. That means that it was, according to our definition, slow. So I drew my corrective channel again and waited for prices to reach the upper boundary of the channel. And the stochastic was also in the perfect position. And you can see on this chart the results of that simple setup. Now, I would like to answer a typical question about this strategy. How do we know exactly when to enter after a retracement? And that's really an interesting question. And to be honest, in many ways, I already gave you the answer. I can summarize it in this way. In a downtrend, after you identify those elegant, fast moves without overlaps, coming down and followed by a choppy, sloppy, slow, and overlapping move, you just throw a channel. And you can sell at the top of the channel as long as an oscillator gives you a sell signal. Otherwise, wait for prices to break the lower boundary of the channel. Now, there are other possibilities, but explaining some of them will easily take another webinar or two. So I will mention a couple that are extremely effective. One is bar reversal patterns, if you use bars. These are unique patterns that by themselves, I tell you honestly, they don't work so well. But one combined with a sound identification of the trend, as the one I have shown you today, the reversal pattern, the bar reversal patterns are really amazing. Another possibility is candle patterns. They work very well. And again, without a clear identification of the trend in the manner that we spoke today, candlestick patterns can be tricky. And another one is Fibonacci retracements. And there is no question that Fibonacci levels work as strong psychological, unconscious levels of support and resistance. And if you remember in my examples, I typically mark the selling or buying zones with the blue rectangle. Those rectangles are the results of a Fibonacci projection, or more specifically, typically a cluster of Fibonacci. I'm sure that some other presenters will teach you about the use of Fibonacci multiples and retracement and all that. But for today, for me, suffices to say that Elliott stated that the mathematical base of the wave principle is precisely the Fibonacci sequence. You can see it all over the place. That's why you can see the 3 waves as corrective, 3 is a Fibonacci number, 5 waves as impulsive, 5 are a Fibonacci number, 8 waves cycle, 8 is a Fibonacci number. And if you notice, in this last example, I show you with the CAD yen, I use Fibonacci retracement. And you can see there, the 78% retracement coincided precisely with the upper boundary of the channel. So I knew that from that area, a major bounce with the power to send prices all the way to the lower boundary of the channel, at least, was likely to happen. Another fantastic tool to aid you in the timing of your entry is price patterns. These are a bit more complex and require a lot more experience. They are more subjective and difficult to interpret, but they too work to project targets for those pullbacks. Elliott identified 13 of those patterns. And if you would like to learn more about spotting patterns, the Elliott Wave Principle presents and its applications, I will be giving a 5-hour summer intensive in less than 2 weeks. The bootcamp will take place on the 15th of August from 11 a.m. to 4 p.m. Eastern Time via GoToWebinar. We call the summer intensive Elliott Wave Made Easy Bootcamp, and we will truly only accept a small number of participants. And here's why. The training is going to be live and interactive, so you have the chance to ask and clarify all the questions you ever had about the wave principle, including the most basic questions like that nobody wants to ask, like where do I start my count? How do I use the Fibonacci tool, etc. We cannot accomplish such an interaction if we have 100 participants or so. So we're planning to stop to cap the registrations at about 30 participants, and then we will close the registration for the live event, and we'll only offer the recordings. So if you're interested in the live event and want to ask and participate, go to the link that you see on the screen. And you know what the best part is? You can take this training for less than small stop in the S&P. I wanted so badly to make this affordable for everyone that I decided to charge only $10 per hour. Since the training is full hours, so the bootcamp is just going to be $50. I figure that that way, even if you are under serious financial stress or are working for minimum wage, you can still benefit from this invaluable opportunity. Once you purchased, I'll send you a personal email with all the information you need to get into the bootcamp. But if you are registering now, please give me a couple of hours before I get back to you. But for sure, I'll get back to you within 24 hours of your purchase. The training is a comprehensive approach that includes all the patterns Elliott observed, described, and drew, and real Elliott applications in a variety of markets. I'm almost aware that many of you have likely tried to learn Elliott before, and I'm almost sure that you found it overwhelming. And I promise you, I will do my very best to make it as simple to understand as possible. So sometimes the most certain way to succeed is to try just one more time. And that's what I tell my future students when they tell me they tried learning the Elliott Wave Principle before, but could not do it successfully. I heard that so many times that I decided to develop a comprehensive, interactive, and intensive bootcamp that allows people to learn the Elliott Wave Principle and its applications in only 5 hours without being frustrated and overwhelmed in the process, as most of us are. You remember at the beginning of this training, I told you I used to be a concert artist. And you see, as a child, I was a musical prodigy. People thought I had special gift to memorize and execute music on the guitar, but all I did was to have a systematic approach to learning. And when I identified it, I was able to teach my students how to apply the exact same system I used. And they too were able to learn and memorize as fast as I did, so there was no genius involved, I assure you that. My teaching system was so successful that I became the youngest music professor in my country's history. Once I became a certified Elliott Wave analyst, I applied the same learning system to teach the wave principle to traders and investors all over the world, so they too could learn it fast and without the typical frustrations involved in the process. I want to give you an example, so I prepared for you a couple of slides here. When people try to learn the wave principle, they are faced with learning the many rules and guidelines that govern the 13 price patterns that Elliott observed. But it takes them days and sometimes weeks, sometimes even months, to even name those 13 patterns, let alone remember the rules and guidelines. And there are many rules and guidelines. There are not just 3 rules like people think. No, there are many, many, many rules. Just impulse waves have 11 rules. So, and the reason is because they try to learn without any systematic order. And so I prepare for you an example here. So take a look at this list and try to remember as many patterns as you can. I'll read it for you. Impulse, zigzags, flats, double zigzags, ending diagonal triangles, expanded flats, contracting triangles, triple zigzags, leading diagonal triangles, running flats, barrier triangles, expanding triangles, running triangles. Now, how many of them can you remember now? Not many, I'm sure. You don't even have to answer. But don't feel bad for that. The reason is not that you have a poor memory or you don't have concentration or anything like that. The reason is that you didn't have any order or association to help you memorize these patterns. Now, let's try the same, but this time, let's put a bit more context as I presented in my Elliott Wave Intensive Bootcamp. So, instead of trying to remember 13 disconnected patterns, I teach my students to think only of 2 wave modalities, just like we did today. Those that move with the trend, they are fast, slim, elegant, etc. And those that move against the trend, that they're slow, fast, choppy, sloppy. Remember that? So the ones that move with the trend, we call motifs, and you already learned that today. And you even learned their characteristics and personalities. And the ones that move against the trend, we call corrections. And you also learned them today. And even if you had forgotten it by now, I'm sure you already memorized these 2 patterns, motif waves and corrective waves. And now let's look at this table and see how those 2 types of wave developments subdivide. There are 2 types of wave modalities, as I told you, as motifs and correction, and 2 types of motif waves, impulses and diagonals. And there are 3 types of corrections, zigzags, flats, and triangles. Easy, right? Notice how much easier now it is to remember those 5 patterns. Remember that corrections move in 3? Well, there are 3 of them, zigzag, flats, and triangles. And guess what? All the other patterns are simple variations of these 5 basic patterns. So you saw triangles. Well, yeah, there could be running triangles. This could be contracting triangles. Could be expanding triangles. But they are all triangles. So it's not necessary to try to learn them the way I did. That was very, very, very confusing. So basically, just by doing this, what we just did today, to organize it in 2 wave modalities, motifs and correction, you can learn the 5 simple patterns of Elliott wave: impulses, diagonals, zigzags, flats, and triangles. Now, how many of these can you name in your mind already? 2, 3, probably all of them, likely. If you remember all of them, congratulations. You have already learned 40 to 50% of what you need to know about the Elliott Wave Principle in order to forecast market direction and improve your trading results. And you learn it in less than 3 minutes. So if you'd like to learn how to apply that knowledge in your trading, so you're able to accurately forecast any financial instrument and take advantage of the next market move, come enjoy the Elliott Wave Bootcamp. It's a summer intensive. And typically, our intensives are attended by professional traders, brokers, fund managers, portfolio managers, etc. But the program is also for futures, stocks, and or forex traders of all levels who want to become profitable traders in the shortest time possible, regardless their market preference, experience, or even account size. And finally, the bootcamp is for any trader who has been struggling to earn money and is in need of turning profitable in the shortest time possible. And so, guys, I took the entire hour, so I don't know if we have time to answer any questions that you may have about what I presented you today. If I do, thank you. And if I don't have enough time, David, please